Thanks for clicking! Canada's fixed mortgage rates are on the rise in the wake of the Bank of Canada saying it may be cutting rates in a few months' time.
How the f*** you do that?
Indeed, while it might seem counterintuitive, despite Governor Macklem's statement that a June rate cut was within the realm of possibilities, Canada saw its bond yields skyrocket yesterday, with mortgage rates following in the wake of hotter-than-expected inflation data coming out of the United States. And the reason for the higher bond yields is not just hot inflation in the US, though that's related, but also the problematic Treasury auctions that were held following the dismal CPI release. And while these rising yields are technically a US problem, they have real implications for us here in Canada, in that, despite what we're hearing on social media, in the media, which is looking more and more like a distinction without a difference every day, a Bank of Canada rate cut in June doesn't necessarily mean lower borrowing costs for Canadians and the housing market taking off.
Trust me, it does.
So what I want to do today is go over what happened in the United States yesterday, discuss why it's a problem for us here in Canada, and then go over some implications for the real estate market heading into June, July, and August. The Treasury Market story is an ongoing story and one that we've been covering since last year. We will continue to provide updates out on this story on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into the United States. Onto these mortgage rates. So why are mortgage rates rising? First, in order of timeline at least, is the US CPI data, which came in hotter than expected yesterday for the third month in a row.
I'm very familiar about all that.
The US saw both headline and core inflation come in hotter than the markets were expecting, and as a result, yields on US Treasuries shot up all across the board. With the yields on the 10-year US Treasury, the amount of money that can be earned by lending the US government money for 10 years, hitting a 2024 high. And to understand why, a brief refresher might be in order. Recall that bond prices and yields are inversely related. So if I buy a 1-year bond at $100 with a 10% interest rate, at the end of the year I'm going to get $110 back. I am yielding 10%. But let's say I run into some financial hardship and I need the money now. So I sell my bond to Jen for $95. Jen doesn't mind waiting the year to get the money. I get my money now, and Jen, having only paid $95 for that bond, is now yielding 14.6%. Jen got that bond for a lower price than I did, and hence her yield went up. I get my money now, Jen gets a good yield, everyone's happy. Except, that is, if inflation is running hot. If inflation is running at, say, 15%, Jen is actually losing money on that bond. Jen is losing real purchasing power. Jen's in the hole 0.4%. As such, Jen isn't going to offer me $95 for that bond. Jen is going to offer me $90. She wants a real return. Jen wants to actually earn a return given the lost buying power due to inflation. She wants to earn a real return on that money in exchange for the risk of lending me money and the opportunity cost of not having that money herself. And that's what happened in the Treasury market yesterday, with US inflation coming in hotter than expected. Now, for a third month in a row, US investors want a greater yield on their investments, selling off their bonds at lower prices, sending yields higher. And the immediate effects of this inflation report were not only evident first thing in the morning in the bond market, but also at the Treasury auctions held that afternoon, the auction of the 10-year government Treasury, 10-year government debt. Given the perceived loss of purchasing power and uncertainty surrounding inflation, investors were reluctant to step up on the purchase of government debt. Which makes sense if you're going to lend the US government money, which is basically risk-free from default. The loans are denominated in a currency they can print. You're going to want a real return on that money. You're going to want a return adjusted for inflation. And yields rose even further following the weak auction. You don't want to lend money out for 10 years if you're not sure how inflation is going to go over that length of time.
Let me talk to them.
And this brings us to the Canadian case. Canada's bonds should have had a banner day yesterday, with the Bank of Canada governor saying that a June rate cut was in the realm of possibilities. However, if we look at the 5-year Government of Canada yields, we saw that on the release of the US inflation data, yields skyrocketed upwards. They fell a bit on the policy announcement and even more when the governor started talking, mentioning the June rate cut, but then shot back up later in the lead up and the aftermath of the US Treasury auctions. And the reason, as we talked about so many times on this channel, is that US debt is considered the safest debt in the world. Tony Soprano, one way or another, will pay his bills. And as such, if the US is paying more to borrow money, if yields are up on US Treasury bonds, then yields are going up on Canadian bonds as well. Investors are going to demand a premium to lend the Canadian government money, as Canadian government debt is seen as less safe to the debt of that of the US. US yields go up, ours follow shortly thereafter, which obviously doesn't seem fair.
Well, if anybody wants to make a move.
In this relative safety of debt trickles right down to the Canadian homeowner. If the US is paying more to borrow money, then the Canadian government is paying a premium to borrow money over and above that, and as such, the Canadian homeowner, which is seen as less safe than the Canadian government, also pays more to borrow money, also sees a rise in fixed mortgage rates. And, as we've talked about on this channel as well, US borrowing isn't expected to slow down anytime soon either, with the US deficit topping $1.1 trillion over the first 6 months of fiscal year 2024, meaning the US borrowed $1.1 trillion more than it took in.
Nothing wrong with that.
Now, there are some other implications stemming from US debt and US inflation, such as geopolitical rivals selling off US treasuries, long-term US structural deficits, interest costs, etc., but we don't need to pile into those right now.
Thank you.
But we have enough data and experience on full display yesterday to show why Canadian borrowing costs, Canadian mortgage costs, could stay high regardless of any cuts coming from the Bank of Canada over the summer. If US inflation continues, that sends bond yields up. If US inflation continues among an increase in US debt, which is a given, that sends bond yields up, both of which send up fixed mortgage rates. As such, if June arrives and the Bank of Canada does indeed cut rates, that doesn't mean that fixed mortgage rates are coming down anytime soon. In fact, fixed mortgage rates could be higher than they are right now, as we saw back in October of 2023. So, as mentioned, yesterday should have been a great day for Canadian mortgage bonds, and as such, we should have seen yields on Canadian bonds go down. But we didn't, and that reason is south of the border. Now, granted, this is just for fixed mortgage rates. If the Bank of Canada lower rates in June, holders of variable rate mortgages will see a decrease in their cost of borrowing. Variable rate mortgages will become a little bit more attractive.
Yes!
Yeah, we'll cross that road again when the time comes. Regardless, as we've talked about so many times on this channel, when you see the usual suspects, when you see in the media that as soon as the Bank of Canada cuts rates, the housing market is going to take off on that lower cost of borrowing, if they're not also talking US inflation, US debt, US yields, they're missing a great big, more important part of the picture. So yeah, it's right there on display. Yesterday was a microcosm of what we could see when the Bank of Canada cuts rates. When the Bank of Canada cuts rates in June. Even though we may get what is perceived to be good news coming from our central bank, good news that should push rates down, what happens south of the border, as we saw yesterday, matters much, much more than what comes from our own central bank. With all of that said, we will continue to track this story coming out of the United States and its effect on our own yields, on our own mortgage market here in Canada on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.